What I'm trying to say here is that this fiction that we've had for the last 2-3 years that the economy is doing really great, that's starting to unravel. and that's why I think the economy is going to get worse a lot quicker, and the markets are going to react a lot quicker because the whole narrative is collapsing. Thursday, August 29th, 2024, Monaco 64, home of alternative economics and contrarian views. So the U.S. Treasury yield curve is pointing to trouble ahead for the economy, and difficult to say how bad it will be. I have a feeling that it could be worse than most people think. Of course, Wall Street and the Fed are going to say that we are in a soft landing, but I think we're anything but going towards a soft landing, and we're going to look at the 2s-10s yield curve spread, which historically has forecast recessions very accurately. And I've also seen that NVIDIA, the company that is supposed to power the AI revolution with its chips, had very good results, but the share price still dropped in the aftermarket. And I'll give you my opinion on artificial intelligence, seeing that I'm the home of alternative economics and contrarian views. But before I do, I just wanted to thank all of you for your interest in the channel, all the new subscribers. And if you have just started watching my videos and my channel and haven't yet, make sure you subscribe. Make sure you hit the like button if you enjoy a particular video. Make sure you share it with friends and family and colleagues as well. And I've been doing this for, 9 years almost now. And I have a huge playlist where I talk about different topics. I've got different playlists, of course. You can look for that on my channel. So thanks again. I haven't really spoken much about AI or artificial intelligence, NVIDIA. And the more I look at other things, the more suspicious I become of it. And why? Well, because I think Wall Street is behind this AI revolution. And why do I say that? Well, because it's the next big thing. They want to push another bubble like they've done since time immemorial. And by that I mean the last 120 years. In the 19th century, it was the railroad craze. And then you had in the 1920s radio and the automobile. Not that those things aren't good, but they always push it. They always talk about the new thing, and they get everyone excited, and then they fleece the general public. That's what they do. In the 90s and early 2000s, it was the dot-com bubble, and after that, it was the flipping houses bubble, the subprime mortgage bubble, and I think now it's clear that it's this tech AI bubble. And what do I think of AI? Well, I think AI is very similar to the big pharma. Big pharma, they don't want you healthy. They want you always sick so you can keep buying their drugs or taking their, you know what, I can't probably mention it here. It starts with a V, as in victory. And you're always sick, and they're making billions. And I think AI is the same. And why do I say that? Well, because it's called artificial intelligence. So my view is that it's going to make everyone very lazy. People won't think for themselves. They won't read a book and do research like, well, I used to do years ago when you go to university. That's what you do. You do a research paper, you take out books, you read, you take notes, you write a, you know, bibliography of all the books that you took. You have to have the sources. But with AI, you can do it in a matter of seconds. You become lazy. You just ask the machine, what's this? Who did this? And I think it's really bad for the human brain. People are going to get lazy, and hopefully, it's all it is it's a fad and a big bubble. I'm not saying maybe some of it can be used, but I think I still want to live my life doing things for myself and thinking for myself. I think that's the most important thing. And I'm not saying there's going to be a crash of NVIDIA or the AI bubble, but it's highly possible, I think. And Wall Street always pushes things, and people always, the markets always get ahead of themselves. And one of the things that I saw recently, or I've seen a few times on YouTube, is some adverts about AI companies. And guess who were the guys doing the advert? Well, it was Mr. Solomon. He's the CEO of Goldman Sachs, and Eric Schmidt, the ex-CEO of Alphabet or Google. And that's highly suspicious. So they were sitting down at a desk talking to each other, almost like they were influencers on YouTube, right? And talking about AI. And that raised a lot of red flags for me. And especially if Goldman Sachs and Eric Schmidt and the CIA are involved in AI, you can bet there's something nefarious about it. That's why I try to avoid it. Unfortunately, these days when you search something on Google, it's coming up AI. I try to avoid that. But anyway, that's the way I see it. Back to the economy. And I think the economy, if you've been watching me here for the last 2-3 years, I've always said, and even before, that the only reason the statistics are pointing to a growing economy, and by that I mean the GDP, is because fiscal policy has been very, irresponsible. And by that, I mean the government has been spending more than it takes in taxation, and it's been running huge budget deficits. And why is that important in terms of knowing how the economy really is? Well, because GDP, which is a Keynesian calculation, of course, for the economy. Why is it a Keynesian calculation? Well, because the Keynesians believe governments and central banks should run the economy, so they have to justify what they do in terms of fiscal policy and monetary policy by keeping track of the economy. And what they do to the GDP statistic is that they add government spending. Nowadays, a lot of it is called government investment, which is really a very dishonest way of putting it, because governments don't invest. They take your money and they spend it irresponsibly in foreign wars and all other kinds of things that waste your money. So if government spending is added to GDP and the government is spending, well, right now, 7% more than it takes in, that's the deficit of GDP, then it translates to a GDP that is artificially higher than it should be, because it's all done through government spending. And government spending doesn't create wealth. It just shows that the GDP is higher, but it's a really bad statistic. In a more perfect world where government is small, there's no central banks, and there's a free market, we don't need government to measure the economy. It's unnecessary. So what I'm trying to say here is that this fiction that we've had for the last 2-3 years that the economy is doing really great, that's starting to unravel. And that's why I think the economy is going to get worse a lot quicker, and the markets are going to react a lot quicker. Because the whole narrative is collapsing, and we saw last week they had to admit that job creation was almost a million really less than the BLS told us from March 2023 to March 2024. So yeah, it's all unraveling really quickly. They can't keep the facade. People are looking behind the Potemkin village, and they're saying there's nothing there. And the yield curve is telling us that. So what's the yield curve? Some of you might not even know. Well, it's to do with the U.S. Treasury market, the bond market. In a normal economic environment, when you borrow for 2 years, let's say the U.S. government borrows for 2 years, let's say it pays 4% to borrow for 2 years. If it borrows for 10 years, it will pay 6% because it's riskier. Our lenders want more for their money over 10 years than they do for 2 years. So that's a normal sloping yield curve. But when the authorities, and that is the Federal Reserve, the U.S. Treasury, when they pump too much currency and credit out of thin air, and they overheat the economy. And actually, it's not really overheating the economy, is that what they do is they debase the currency too quickly, and it feels like it's overheating the economy. But all they're doing is this budget deficit spending, and it looks like, what it does as well, it misallocate resources, and you get job creation that's not really healthy in the long term. And by that I mean jobs that shouldn't really be there. So when they see this overheating, what the Fed will do is that they will raise rates quite aggressively. And we saw that from 2022 until 2023. They had to raise rates from 0 to over 5%. So what that does, the Fed can really only control short-term rates. So the short-term rates went to 5 or more. And then the longer-term rates started coming down because the markets saw that this was going to slow things down. And it got to a point where the 10-year yield became less than the 2-year yield, and that's called yield curve inversion. And according to this post on X here, the current inversion has lasted 24 months, and prior to that, the longest inversion was 16 months, and I think that was in the late 70s, early 80s. And does it predict a recession, the inversion? Kind of, but it's only when the curve gets to above negative or disinverts that the market's pointing to the unraveling or a recession of the economy. And right now, as I speak here, the 2-year yield is at 3.87 and the 10 years at 3.84. So it's still inverted by 3 basis points. But that could change very quickly. It could change even later on today when the U.S. markets open, and it could change next week after the non-farm payroll number. So what that is going to point to is that we're going to have a recession in the next, probably 6 months, and it could be even quicker because, as I said, I think they've been embellishing the economy and things. a lot more than they have in the past. So when that happens, the Fed will cut rates, and people are expecting them to cut rates on September 18th. And I think they might have to do a lot more than the market might be forecasting right now. And that's only going to help gold and silver. If you look at when the Fed started cutting its cutting rate cycles in the past, it's helped gold and silver massively. And gold and silver have done actually really well, despite the fact that we went from 0 rates to 5%. Most people thought gold and silver were going to crash completely because they said, well, we're going to have real rates of return. That's going to be bad for gold. But I think the reason why it hasn't been is because people, investors and foreign investors especially, don't believe the CPI data. They know that they're losing out even by getting 5 or 4% on their treasuries, because the dollar is being trashed a lot more. It's all a fabrication. So there you go. That's how I see things. Let me know what you think in the comment section. I'll try to go through all the comments as well as I can. Sometimes it's difficult to go through all of them. And yeah, so let's quickly look at the markets now. This morning, it's 8:24 a.m. London time. We've got spot gold at 25.18. That's up $14 or 0.5%. High's been 21 and the low has been 25.01. Yeah, gold's still doing really well. It doesn't feel like it, which is interesting. The sentiment is nothing like it should be, seeing that gold is at near an all-time high, which was around 25.31, I think, a week or two ago. And the fact that gold is up over 20% a year to date, actually. And yeah, we saw a little bit of choppiness yesterday, but gold and silver are picking back up. Silver, really, the key level right now is 30. We got above that level yesterday and the day before, but they smacked it down yesterday. Right now, though, silver's up almost 50 cents or 1.6% at 29.60. High's been 62, the low 29.06. So the Dow futures is up 180 points. The NASDAQ 100 futures down 33, and the S&P is down just a point. So fairly quiet. The good results from NVIDIA haven't really helped the NASDAQ. So that could be a negative signal for the stock market, seeing that even despite good news, the market is not reacting positively. What about the currencies? Well, I'm still looking at the dollar yen. That's still holding above 144. We need to keep an eye on that. If we drop below that level, I think things could get a little choppier in the risk assets, as they call it. Yeah, that's about it for today. And with that, I'm going to wish you all a very good day. Take care. Bye.